In this video, we are going to master the concept of open interest walls, often called OI walls. By the end of this session, you will be able to identify key support and resistance levels using option chain data and integrate these walls into your live trading strategy to set more accurate profit targets and stop losses. Let's start with the basics. What exactly is open interest? While volume tells us how many contracts changed hands today, open interest tells us how many contracts are currently active and open in the market. Think of it as the amount of capital currently parked at a specific price point. When you see a massive spike in OI at a specific strike price, it means the big players, the institutional sellers, have a vested interest in that level. Trade toward an OI wall, not blindly through one. At the end, use Dhan trading platform for best trading experience. Use referral code EJZZI96380. Now that we understand what open interest is, let's look at how to interpret it. In the options market, we look at call open interest and put open interest separately. To interpret this, we list the strikes and the amount of capital positioned at each. High call open interest acts as resistance, while high put open interest acts as support. Sellers are the ones who primarily drive these levels. To understand why, we have to think like an option seller. Most retail traders buy options, but the smart money often sells them. If a large institution sells a massive amount of calls at a specific strike, they lose money if the price goes above that level. Therefore, they will use their capital to defend that level, creating a ceiling or resistance. Conversely, if they sell a massive amount of puts, they will defend that level to keep the price above it, creating a floor or support. These floors and ceilings are what we call OI walls. At the end, use Dhan trading platform for best trading experience. Use referral code EJZZI96380. Let's dive deeper into the mechanics of why these walls act as barriers. To do this, we need to understand the risk profile of the people creating these walls, the option sellers, also known as writers. The seller's perspective. Sellers have unlimited risk. They require high margin or capital. They are usually institutional players. Their goal is that the price stays away from their strike. Notice the payoff chart on the right. This is for a trader who has sold a call option. As long as the market price stays below the strike, they keep the premium. But look at what happens if the price moves significantly above that strike. The losses start to accelerate, because these sellers are often large banks or hedge funds with millions of dollars at stake. They aren't just passive observers. When price approaches their strike zone, they may sell the underlying asset or sell even more options to keep the price suppressed. This concentrated effort is what creates the physical wall on our charts. For the best trading experience, use the trading platform and our referral code EJZZI96380. Now, let's look at the specific data points we have for today's market to see these walls in action. This is where the theory meets the reality of the numbers. Look at the magnitude here. We have roughly 80 lakh contracts sitting at the 24,500 strike. In the world of trading, lakh refers to 100,000, so we are talking about 8 million contracts concentrated in a very narrow 50-point range. This represents a massive amount of capital committed to preventing the price from breaking higher. This is a strong resistance zone. On the downside, we see a significant green pillar at 24,000 with 47 lakh contracts. While smaller than the call wall, it still represents a formidable, strong support floor, where buyers are expected to step in. For the best trading experience, check out the Dhan trading platform using referral code EJZZI96380. Let's visualize how this data translates onto a price chart. Understanding the numbers is one thing, but seeing them as physical barriers on a candlestick chart is how you make trading decisions. Notice the price action here. When the price is floating in the middle, around 24,250, it is in a neutral zone. However, as it creeps up toward that red shaded area, our 80 lakh contract call wall, the probability of a reversal increases significantly. Why? Because thousands of sellers are watching their profit margins shrink as the price rises. they will likely sell the index futures to push the price back down. Similarly, if the price drops toward 24,000, the put sellers will start buying to protect their positions. In a market like this, the price is effectively trapped between these two high-conviction zones. Before we move on, take a second to look at this chart. If you were a buyer at 24,250, where would your logic tell you to take profits exactly just before that massive red wall? Use Dhan trading platform for best trading experience. Use referral code EJZZI96380. Now that we can see the walls, let's discuss the golden rule of using this data live. Trade toward an OI wall, not blindly through one. Many beginner traders see a price rising and think it will go on forever. A professional trader checks the option chain first. Imagine you see a bullish signal at 24,100. You look up and see that the nearest major call OI wall is at 24,450. This gives you about 350 points of room to run. This is a high probability trade because there is no immediate ceiling to stop the momentum. However, if you saw that same bullish signal but the price was already at 24,420, entering a long position would be very risky. You would be buying right into a wall of 80 lakh contracts. The smart move is to use that wall as your profit target for an existing trade, or wait for a reversal signal to trade back toward the 24,000 support. Always remember, the wall is your reference zone. It tells you where the big players have placed their bets. You want to align your trades with that gravity, not fight against it. For the best trading experience, use Dhan trading platform. Use referral code EJZZI96380. Let's go through a step-by-step worked example to see how this logic applies to a trade setup. Imagine it's Tuesday morning, and you are looking at the Nifty index. In this scenario, the price is sitting at 24,050. When we check our OI data, we see that the 24,000 put wall with its 47 lakh contracts is only 50 points away. This wall acts as a safety net. If we enter a buy or long position here, we can place our stop loss just below 24,000. Why below the wall? Because for the price to hit our stop loss, the market would have to break through the conviction of millions of contracts held by institutional sellers. That is a difficult task. Meanwhile, our upside target is the 24,450 call wall. This gives us a massive potential reward of 400 points, compared to a very small risk of about 70 points. This is what we call a high probability trade setup, fueled by OI data. We aren't just guessing that the price will go up. We are identifying where the floor is and trading away from it toward the next ceiling. At the end, use Dhan trading platform for best trading experience. Use referral code EJZZI96380. It is also important to remember that OI walls are not permanent. They are dynamic. In a fast-moving market, these walls can shift or even crumble. This leads us to a critical concept, the short covering rally. What happens when a wall fails? If the price manages to push above the 24,500 call wall despite the 80 lakh contracts, those sellers begin to lose a lot of money very quickly. To stop their losses, they must buy back the calls they sold. Think about that. Sellers becoming buyers. This creates a surge in buying pressure that can catapult the price even higher. This is why, if you see the OI at a wall starting to decrease while the price is testing it, you should be prepared for a breakout. Monitoring the change in OI throughout the day is just as important as looking at the total OI. It tells you if the walls are getting stronger or if the sellers are starting to run for the exits. For the best trading experience, use the Dhan trading platform. You can use our referral code EJZZI96380 to get started. To successfully trade with open interest walls, you need a platform that provides this data in real time with high-quality visualization. That is why I recommend using the Dhan trading platform. Dhan is designed specifically for traders who need to see these clusters of capital clearly and quickly. Whether you are tracking the 80 lakh contracts at resistance or the 47 lakh contracts at support, Dhan's interface makes it incredibly intuitive to spot where the big players are positioned. For the best trading experience and to start applying everything we've learned today about OI walls, use the referral code EJZZI96380 when you sign up. We've covered how OI represents the skin in the game, how call walls act as resistance while put walls act as support, and how to use those levels to define your trade path. You are now equipped to look at an option chain not just as a list of numbers, but as a map of the market's battleground. Take a moment to look at your current charts. Where are the walls today? Trade toward them, respect them, and always manage your risk. Happy trading.